Jalinrani, MD, Oil and Gas Research at Macquarie Capital as well, joins in on the show. Jal, hi, morning. How serious is the Syria issue on your view, and how much flare-up can it lead to in crude prices for us?
Well, Syria actually is not a large producer of oil. The concern is more that it has got strong alliances with Iran, and that could result in disruption of production from Iran. My thought is that even that is not a significant concern, because Iran is actually producing way below its optimal capacity, and it's got plenty of spare capacity elsewhere if parts of the production get disrupted. So my thought is that this rise in crude prices is more sentimental at the moment rather than fundamental.
Do you think the demand side of oil is looking slightly weak because China has not stabilized? In US they've discovered shale gas, and emerging market economies which have been big guzzlers for oil, they are slowing down?
I think the demand side globally is swinging around significantly and is significantly diverse. So the US, which actually consumes one-fifth of world demand, is reviving, and that's a very big swing factor. Of course, on the other hand, locally in the US, they are ramping up shale gas liquids, which is akin to oil, very aggressively, and in fact over the next few years could become a larger producer of oil and related than even the Saudi Arabia. On the other hand, of course, demand in this part of the geography has slowed down, especially India. I would say do not underestimate India's demand swings. India is the fourth largest producer of oil in the world, and its largest product, diesel, which is 46% of consumption, demand growth has gone from 16% year-on-year growth roughly the same time last year to at the moment a negative 6% growth. So the demand swing in this part of the world is actually slowing down, and in fact in India even turned negative, while the US is actually growing. So it's not a net decrease as yet, but it's just demand centers have been shifting.
So Chal, what happens to crude prices from here? As you say, the sentimental risk, is all of that priced in? How much more escalation can we see?
Well, our global oil economist at the moment is not looking at crude prices exceeding $110 this year. So net at the moment there is no significant cause for concern.
So let's talk about companies or Indian companies which will benefit and which will lose because of the sudden spike in crude. The big losers are obvious, which is OMC stocks. But secretly, do you think it's time to buy into Reliance? A, Reliance is a big exporter. B, Reliance will also benefit because of a weak rupee. And in 2014, when gas prices they are deregulated, or when gas prices are increased, they will be denominated in dollar, and Reliance could hit a jackpot.
Okay. All right. Too many questions there. Firstly, on the contrary, I disagree with you. I think that the oil sector in general in India is actually a net beneficiary and a material net beneficiary. So to start with, the upstream oil and gas that is linked to international, I mean that's dollar denominated. So those are clear beneficiaries. Similarly, the refining margins are again dollar denominated. The only concern is on the OMC's retail, as you correctly put it. But there again there are 2 points. One is that the OMCs are already bearing a maximum burden that they can bear, including last year. So I don't believe that they can bear any more. And the government knows that, because if these companies are forced to bear significantly higher quantities, you're risking actually 99% of the petrol pump and oil product distribution in the country. So you'll have economic chaos if you have that sort of a disruption. So I'd say even for the OMCs, that's out of the question. And within the OMCs, actually the market is using just broad brushes. If you look at BPCL, which is actually your top pick, one is BPCL is actually more an upstream company. Its upstream value, including Mozambique, Brazil, a Kaveri find in India, is actually as much as the entire stock price today. So it's actually not only a net beneficiary, but you're getting its refining and underlying oil marketing businesses for free. So it's unfair to actually firstly say that the sector is not a beneficiary. On the contrary, it's a beneficiary. And within the OMCs also, one needs to actually pick correctly, which is BPCL. Coming to Reliance Industries, you're correct. It not only exports 75% of its refined products, but even petrochemicals is basically a dollar import parity basis. So that's basically a dollar denominated business. So Reliance would certainly be a beneficiary. This quarter may nevertheless be offset by, at the moment, very weak gross refining margins. So Singapore complex margins as a benchmark have nearly halved in the last couple of months and are ruling at about $4 a barrel. So yes, Reliance does benefit, but not perhaps as much in this quarter.
So in such a scenario, that is the currency weakness and spike in oil prices, what happens to names like Ken? In the near term, we've been seeing an uptick. Would that trade last?
Of course, Ken is the most sensitive to, it's Asia's only pure oil play, relatively speaking. So it's by far the most sensitive. We estimate that roughly a dollar increase in crude prices enhances the earnings by about 2%. So that's an obvious thing. The only caution that I'd like to suggest is that it's possible that the government may increase Ken India's cess burden on crude, which is a rupee denominated cess burden. That's a tax. This was nearly doubled from $2,500 a ton to $4,500 a ton 2 years back, and there's no reason why the government can't increase it further. So it's possible that the government may take away at least some of this upside.